What if I told you that the foundation of the next multi-billion-dollar direct-to-consumer tech platform isn't being built in some, like, sleek Silicon Valley garage, but it's actually sitting inside a small plastic vial of your blood?
I mean, it sounds a little dramatic when you put it like that, but honestly, looking at the data, you're not wrong.
Right. Today, we're looking at a company that Wall Street traditionally treats as kind of a boring back-end utility, like the plumbing system for the healthcare industry. But the numbers we're about to unpack tell a completely different story.
Yeah, they really do.
So welcome to a special Talk Tickers edition of our Deep Dives. Our mission here is simple. We take corporate earnings calls, we strip away all the polished executive jargon, and we figure out what the math is actually telling us about the future of a stock.
And for today's deep dive, we have our magnifying glass firmly fixed on Labcorp, ticker symbol LH.
Yes, exactly. We've got their Q2 2026 earnings conference call transcript, all the supplemental financial data, and we're going straight past the corporate speak. We need to figure out if this company is, quietly transforming into a digital health juggernaut, and more importantly, what that actually means for you as a retail investor.
It's a fascinating premise to start with, really, because when you look at a company like Labcorp, the market tends to misprice them based on, these really outdated models.
Yeah, people think of them just as the place you go when your doctor wants to check your cholesterol.
Right, but looking through this Q2 transcript, the volume of high-level proprietary data they are aggregating and how they're monetizing it, it suggests a structural shift in their entire business model.
And that is exactly the tension we need to explore today. Is this just a reliable, slow-growth medical testing company, or is it a tech-enabled health data hub that's currently sitting on sale?
Well, to answer that, we have to start where the rubber meets the road for any investor.
The actual financial print for the quarter. Let's look at the headline numbers. And I'll be honest, I was taken aback when I first opened this file. Revenue hit $3.7 billion for the quarter,
which is up 5.8% year over year.
Right. And before you just assume they bought that growth through some massive acquisition spree, the underlying data shows something much, much stronger.
Yeah, you're referencing their organic constant currency growth, which honestly is arguably the most important metric for a global operator like this.
Break that down for us real quick for anyone who isn't staring at spreadsheets all day.
Sure. So when we say organic, we mean growth generated from their existing core business operations. We're completely stripping out the revenue they bought by acquiring other companies.
Okay, so just the raw engine of the business.
Exactly. And when we say constant currency, we are removing the optical illusion caused by foreign exchange rates. I mean, Labcorp operates globally, right?
Right.
So if the US dollar is particularly strong, the revenue they earn in euros or yen, it looks smaller on paper when they convert it back to dollars to report to Wall Street.
Even if their actual European business is booming.
Precisely. By looking at the organic constant currency basis, we strip away the currency mirage, we take out the acquisition noise, and we see the true health of the business. And that number was 4.2%.
Okay, so the actual raw engine grew by 4.2%. They only had, a tiny 1.2% bump from net acquisitions and like a marginal 0.4% impact from currency fluctuation.
Yeah, the core business is accelerating.
Look, top-line revenue is only half the story, right? You can sell $1 billion of a product, but if it costs you $1,001 to make it, you're still going bankrupt.
Oh, absolutely.
Which is why the bottom line number in this transcript is what really caught my attention. Their adjusted earnings per share, their EPS, came in at 4.99. That is a 14.9% increase year over year.
It's massive.
It is. Growing your bottom line by nearly 15% when you're a mature healthcare company doing billions in revenue, that is incredibly difficult to do.
Yeah.
How are they squeezing that much profit out of a 5.8% revenue increase?
The answer lies in their operating leverage, specifically their adjusted operating margin. For the enterprise as a whole, their operating margin expanded by 70 basis points, bringing it up to 15.8%.
Let's pause right there and define that, because Wall Street loves to throw around basis points to make tiny fractions sound super important. A basis point is just 1/100th of a percentage point.
Right.
So 70 basis points is 0.7%. To a layman, a 0.7% improvement sounds like a rounding error. Why are you zeroing in on that?
Because you have to apply that 0.7% to a massive denominator. Expanding your profit margin by more 0.7% on $3.7 billion of revenue, that equates to tens of millions of dollars dropping directly to the bottom line.
Without having to spend a single extra dime on sales or marketing?
Exactly. It represents pure operational efficiency. And what's fascinating here is that there's a critical piece of context that an analyst from Operon Research tried to challenge management on during the Q&A portion of the call.
Oh, right. The analyst brought up the Invitae acquisition. So for background for you listening, Labcorp bought a massive medical genetics company called Invitae. And the analyst basically suggested that this 70 basis point margin expansion wasn't real operational efficiency, but just like an accounting illusion.
Yeah, he was fishing for that angle.
Can you unpack the mechanics of that argument? Like, why would an acquisition create a margin illusion a year later?
Well, it happens all the time in corporate finance. When a company makes a massive acquisition, the first year is just incredibly messy.
You got integration costs, redundant software systems.
Yeah, you might have 2 HR departments until you consolidate.
Yeah.
All of those temporary one-time costs, they drag your profit margins down.
Right.
Then, 12 months later, you lap the anniversary of that acquisition. Those temporary integration costs just disappear from the ledger. So suddenly your margins look vastly improved compared to the previous year simply because you aren't paying integration fees anymore.
Ah, okay. So the analyst was trying to figure out if Labcorp's impressive 70 basis point expansion was just the result of lapping those Invitae costs.
Exactly. But management aggressively pushed back on that narrative. They stated unequivocally that this margin expansion happened after they had already accounted for lapping the Invitae acquisition.
Meaning this isn't a mirage created by expiring integration costs. This is genuine structural improvement in how they run their laboratories.
Precisely. They have fundamentally lowered the cost of running their business while simultaneously increasing the value of the services they provide. In fact, this marks the 5th consecutive quarter they've expanded their operating margin for both the overall enterprise and their main operating segments.
5th consecutive quarter. Wow.
Yeah, consistency like that proves it's a systemic improvement, not just some one-off accounting quirk.
Okay, look, I hear the bull case on the margins. But if we are doing a True Talk Tickers deep dive, we have to look for the cracks in the foundation.
Fair enough.
And while I was reading through the supplemental financial data, there was one number that made me stop dead in my tracks. Because we always say that revenue is vanity, profit is sanity, but cash is reality.
Cash flow is everything.
Free cash flow is the absolute lifeblood of any corporation. It dictates their ability to weather a recession, pay dividends, or buy back stock. In the second quarter of last year, Labcorp generated $543 million in free cash flow. This quarter, it plummeted to $314 million.
It's a big drop.
We are talking about a drop of over 40% year over year. You are praising their operational efficiency, but a 40% implosion in free cash flow usually means a company is bleeding money. What is actually happening here?
On the surface, I agree, it looks terrifying, which is exactly why it is vital to read the actual transcript of the CFO's commentary rather than just, relying on a stock screener.
Right.
CFO Julia Wang addressed this directly, and the 40% drop has nothing to do with burning cash or losing business. It comes down to 2 very mundane structural realities of corporate finance.
Which are?
Working capital timing and strategic capital expenditures.
Okay, break down working capital timing for me. Because in a normal business, if you sell a widget, you get the cash that day. Healthcare billing is obviously a different beast entirely.
Oh, healthcare billing is arguably the most complex payment system on Earth. When Labcorp performs a test, they book the revenue immediately. However, they don't get the cash immediately.
Because they have to bill insurance.
Exactly. They have to bill an insurance conglomerate or Medicare or a hospital system. The working capital cycle is the time it takes for that massive institution to actually process the claim, cut the check, and deposit it into Labcorp's bank account.
So it's just a lag time.
Yeah. Sometimes a massive payer might process a batch of payments on, say, July 2nd instead of June 28th. Labcorp booked all that revenue in Q2, but the actual cash didn't arrive until Q3.
Oh, okay. So it is a temporary optical mismatch on the balance sheet, not a loss of capital. The cash is guaranteed. It is just in transit.
Exactly. A multi-million-dollar check clearing 3 days late drastically alters the quarterly snapshot, but it doesn't change the annual reality.
That makes a ton of sense. You mentioned the second factor was capital expenditures.
Yes. So free cash flow is calculated by taking your operating cash flow and subtracting your capital expenditures, the money you spend on physical assets.
Like building new labs, buying highly advanced testing equipment, upgrading software.
Right. Management has deliberately chosen to keep their capital expenditures elevated at roughly 4% of total revenue. They are choosing to spend cash right now to build the infrastructure required for future growth, rather than hoarding it to make the quarterly free cash flow number look prettier.
And, if a listener is still nervous about liquidity, all you have to do is look at how they deployed their capital during the quarter. If a company is secretly facing a cash crunch, they hoard every penny.
Right. They freeze spending.
But Labcorp did the exact opposite. During the same quarter, where free cash flow optically dropped, they retired $500 million in senior notes. They effectively paid off $500 million in debt.
You simply do not do that if you are worried about making payroll next month.
Exactly. After extinguishing that debt, they still ended the quarter with $142 million in cash, and they maintained their full-year free cash flow guidance of roughly $1.3 billion. The financial engine is completely intact.
It's a textbook example of why retail investors must dig deeper than the headline algorithms. The algorithms see a 40% drop in cash flow and trigger a sell alert. The informed investor reads the transcript, sees they paid off $500 million in debt and are just waiting on some insurance checks to clear, and recognizes a buying opportunity.
All right, so the headline numbers hold up under scrutiny. The top line is growing, the margins are expanding, the balance sheet is rock solid. But as we know, past performance doesn't guarantee future returns. To figure out where this stock is going, we have to understand the mechanisms driving this growth.
We need to look under the hood.
We do. We need to split this company apart and examine the two primary engines powering it. You've got the Diagnostics segment and the Biopharma Laboratory Services segment, which they refer to as BLS. Let's start with Diagnostics because that is the behemoth.
Yeah, that's the core business.
It accounts for $2.9 billion of their $3.7 billion in quarterly revenue, and it grew at a very healthy 5.5% year over year. But to truly understand how they are growing this segment, we need to translate a very specific piece of laboratory jargon. The entire industry revolves around a metric called an accession. What exactly is an accession, and why does it matter so much?
An accession is the foundational unit of measurement in the lab business. Simply put, an accession is a single patient encounter.
Right.
So if you walk into a clinic, sit in the chair, and a phlebotomist draws a vial of your blood, that constitutes one accession.
So it's essentially a measure of foot traffic.
Yes, but here is where the economics of the laboratory business get fascinating. During that one accession, that one physical visit, the doctor might have ordered a single basic test, like a standard lipid panel, to check your cholesterol.
Right.
Or from that exact same vial of blood, the lab might run a dozen different highly complex genetic and metabolic tests.
And this is the crux of the entire margin expansion thesis. Because the cost structure of an accession is heavily fixed. Think about it. When I walk into a Labcorp facility, the company has to pay the rent for that building. They have to pay the hourly wage of the phlebotomist. They pay for the plastic vial, the needle, the shipping logistics to get that vial to a testing center.
Right, all fixed costs.
Exactly. All of those are fixed costs associated with the accession. Whether they run one test on that blood or 10 tests, those baseline fixed costs remain exactly the same.
Which means every additional test run on that single vial of blood represents almost pure, unadulterated margin. Yeah, the marginal cost of the chemical reagents needed to run a second or third test is negligible compared to the fixed cost of getting the patient into the chair. Therefore, the holy grail for a laboratory company isn't necessarily just driving more accessions, it is driving more tests per accession.
And that is exactly what the transcript reveals. Management reported that their overall volume measured by accessions grew by 3%. So more people are walking through the doors. But the revenue for the segment grew by 5.5%.
Yeah, there's a gap there.
The gap between the 3% foot traffic growth and the 5.5% revenue growth was driven by what they call favorable price mix. And CEO Adam Schechter was very explicit that this favorable mix was heavily driven by an increase in tests per accession.
It is a structural transformation of their revenue quality, and they aren't achieving this by just randomly hoping doctors order more tests. They are achieving this by aggressively shifting their focus towards specialty testing.
Which area specifically?
Oncology, neurology, autoimmune diseases, and women's health. Schechter noted that these specialty areas collectively delivered double-digit revenue growth in the first half of the year.
Let's think about this practically. Using an analogy, imagine a traditional shopping mall. The basic routine blood work, checking your vitamin D levels or your cholesterol, that's like the small kiosk selling phone cases in the middle of the walkway. It generates some revenue, but it's low margin and easily replaceable.
Right, it's a commodity.
Exactly. Oncology testing, on the other hand, is the massive anchor tenant. It is the Apple Store or the Nordstrom. If a patient is diagnosed with cancer and goes on an advanced immunotherapy treatment, they aren't just getting one test. They require a massive battery of highly complex, incredibly expensive tests over a sustained period of years to monitor how their body is reacting to the treatment.
And by capturing that oncology patient, Labcorp effectively guarantees a massive recurring stream of tests per accession. Schechter made this exact point during the analyst Q&A. He emphasized that they aren't just targeting the oncology test, they are targeting the oncology patient.
Because Labcorp offers a menu of over 6,500 different tests.
Right.
Yes. So an oncologist doesn't have to send one sample to a specialty genetics lab and another sample to a local hospital. They can order everything through Labcorp. The scale becomes a self-reinforcing moat.
And we aren't just talking about generic cancer screenings here. The level of scientific complexity they're offering is staggering, and it perfectly illustrates why they command such high margins.
Did you see the genotyping test they mentioned?
Yes, that's exactly what I wanted to bring up. Let's dig into the biological and financial mechanism of that for a second, because it proves why their strategy is working. When a patient is prescribed a standard chemotherapy drug, their body relies on specific enzymes in the liver to break that toxic drug down and clear it from their system.
But a certain percentage of the population has a genetic mutation where they simply do not produce enough of that enzyme.
Exactly. It is a field called pharmacogenomics, and the implications are literally life or death. If a patient with that specific genetic mutation receives a standard dose of that chemotherapy, their body cannot metabolize it. The drug builds up to lethal, incredibly toxic levels.
And historically, oncologists wouldn't know a patient had this deficiency until it was too late and the patient suffered severe adverse reactions.
Right. But Labcorp's new genotyping test analyzes the patient's DNA before the first drop of chemo is ever administered to see if they possess that specific enzyme deficiency. If they do, the oncologist can drastically lower the dose or choose a different drug entirely.
It's incredible.
This test isn't just a nice to have, it prevents catastrophic outcomes. Therefore, it commands a massive premium reimbursement rate from insurance companies, because paying a few $1,000s for a genetic test is infinitely cheaper than paying hundreds of thousands of dollars for a prolonged ICU stay due to chemotoxicity.
That is the perfect encapsulation of their margin strategy. They are moving away from being a commodity provider of routine blood work where they have to compete on pennies, and they are establishing themselves as an indispensable partner in precision medicine.
Are there other examples of this in the quarter?
Oh, yeah. They also highlighted expanding access to a companion diagnostic for prostate cancer, a new agreement for a test that monitors graft injury following a kidney transplant, and securing Medicare coverage for a novel blood-based test for patients at risk of severe liver disease.
Wow.
Every single one of these tests requires specialized equipment, specialized knowledge, and carries incredibly high margins.
It fundamentally changes how you have to value the company. They are utilizing their massive established logistical network, the thousands of local patient service centers where you get your blood drawn as the funnel to feed highly lucrative proprietary diagnostic tests into their centralized specialty labs.
Exactly. That is why the diagnostics engine is humming.
But Labcorp has a second engine, the Biopharma Laboratory Services, or BLS. This segment brought in $836 million for the quarter, up 6.5% year over year. And this is where the story gets really interesting for investors, because a year ago, Wall Street hated this segment.
Oh, they despised it.
It is essentially a massive redemption story. To understand the turnaround, we have to look at the two distinct units within the BLS segment. Walk us through Central Laboratories first.
So Central Laboratories currently makes up about 70% of the segment's revenue. And Central Labs is an absolute powerhouse right now. They provide standardized testing for pharmaceutical companies conducting global clinical trials.
Okay.
In this quarter alone, that specific unit grew an astonishing 7.6% on an organic constant currency basis.
Let's explain why a pharmaceutical giant like Pfizer or Merck would outsource this to Labcorp. If a pharma company is spending $1 billion developing a new drug, why don't they just test the clinical trial patient's blood in their own labs?
It comes down to a concept called assay harmonization and the strict logistical requirements of the FDA.
Okay, explain that.
Imagine a pharmaceutical company is running a phase 3 clinical trial for a new diabetes drug. To get enough diverse patients, they have to run the trial at 50 different hospital sites across 30 different countries.
Right. Massive scale.
If a patient in Tokyo gets their blood drawn, and the hospital in Tokyo spins that blood in a centrifuge at a certain speed using a specific chemical reagent, and then a hospital in London uses a slightly different machine with a different reagent, the data is completely compromised. The FDA requires absolute, unbroken uniformity.
They need apples-to-apples data or the billion-dollar drug gets rejected.
Exactly. So instead of relying on 50 different local hospital labs, the pharma company hires Labcorp. Labcorp creates standardized testing kits, ships them to all 50 global sites, and then utilizes their massive logistical network to fly those blood samples back to a few centralized, highly controlled Labcorp facilities. Every single sample is analyzed on the exact same machines, using the exact same protocols. Labcorp provides the pharmaceutical industry with bulletproof data integrity on a global scale. It is a logistical moat that is nearly impossible for a new competitor to replicate, which is why that business is compounding at nearly 8%.
So the Central Labs unit is the star. But the second unit within BLS, the early development unit, has historically been the problem child. Early development focuses on helping pharma companies in the very nascent preclinical stages of drug discovery, things like animal testing and early toxicity screening.
Right.
And for the last few years, that unit has been a serious drag on Labcorp's earnings. Investors have been calling for them to spin it off or shut it down.
It was a classic case of corporate bloat in a declining market segment. The early stage biotech funding environment dried up, smaller startups stopped spending on early development, and Labcorp was left with underperforming facilities and massive overhead.
But this quarter, the narrative completely flipped. The early development unit posted 2.7% organic constant currency growth. They finally stopped the bleeding and returned to positive growth. How did they execute that turnaround so quickly? Because management promised they would fix it, and it seems they actually delivered.
They executed a ruthless, highly targeted series of strategic cost-cutting and restructuring actions. While they didn't provide, an itemized receipt of every fired employee or closed facility, management confirmed on this call that all previously announced strategic actions within the early development unit are now largely complete.
So the heavy lifting is done.
Yes. They closed unprofitable testing sites, consolidated their operations into their most efficient labs, and refocused their sales teams entirely on high-margin early toxicology screening. They took the short-term pain of restructuring costs to structurally fix the unit.
And the proof that it worked isn't just in the 2.7% growth rate, it's in the profitability. Because they leaned out the early development unit while simultaneously booming in the Central Labs unit, the operating margin for the entire BLS segment expanded by a massive 130 basis points year over year, hitting 17%.
They fixed the leak in the hull, and now the entire ship is moving significantly faster.
But as an investor, you want to know if that growth is sustainable or if this was just a lucky quarter.
Which brings us to one of the most vital metrics in the entire transcript. The book-to-bill ratio.
Ah, yes. If you are investing in any company that operates on long-term contracts, whether it's defense contractors, enterprise software, or clinical research organizations like Labcorp, the book-to-bill ratio is the single most important leading indicator of future revenue. It tells you exactly what is coming down the pipeline.
Walk us through the exact math of how that works.
Sure. The book-to-bill ratio compares the total value of new contracts signed in a quarter of the bookings to the total amount of work actually completed and billed as revenue in that same quarter. Okay, give us an example.
Let's use a simplified hypothetical. Imagine Labcorp completes and bills $10 million worth of clinical trial testing in Q2. That is the bill side of the equation. In that exact same 3-month period, their sales team signs $10 million worth of brand new future clinical trial contracts. Their book-to-bill ratio would be exactly 1.0.
So they are replacing their revenue dollar for dollar. A ratio of 1.0 means you are treading water, your backlog isn't shrinking, but it isn't growing either.
Correct. Anything below 1.0 is a massive red flag because it means you are burning through your backlog faster than you can replace it. Revenue declines are imminent, but anything above 1.0 means your future pipeline is actively expanding.
And for this quarter, Labcorp reported a book-to-bill ratio of 1.14. That is an incredible number. For every single dollar of work they completed and billed this quarter, they signed $1.14 in brand new contracts for future work.
Exactly. And management noted that even if you zoom out and look at it on a trailing 12-month basis to smooth out any quarterly lumpiness, the ratio is still 1.03. The pipeline is structurally expanding.
And they are currently sitting on a staggering backlog of $8.7 billion.
Wow.
They have $8.7 billion worth of legally binding contracts signed, sealed, and waiting to be converted into actual revenue.
And they also provided a crucial piece of revenue visibility regarding that backlog. They anticipate converting approximately $2.7 billion of that $8.7 billion backlog into actual revenue over the next 12 months.
Wow.
Yeah, when you are trying to build a financial model to value a stock, knowing that a company already has $2.7 billion of next year's revenue contractually locked in drastically reduces the risk profile of the investment. It provides a massive floor under the stock price.
Okay, so we've covered the clinical side, the pharma side, the structural improvements in the core business. But there is one more element buried in this transcript that we absolutely have to dissect, because it ties directly into that provocative question we asked at the top of the show. Is Labcorp transforming into a consumer technology platform?
Right.
While Wall Street is hyper-focused on the clinical trial backlog, Labcorp is quietly racking up some massive consumer tech wins that could completely redefine how they interact with patients. The CEO spent significant time highlighting the launch of a product called ColoSense. Let's talk about the biological mechanics of this, because it's a massive leap forward in preventative medicine.
ColoSense is the first FDA-approved RNA-based colorectal cancer screening test that offers an at-home collection option.
Okay, let's unpack why that's a big deal.
To understand why this is such a paradigm shift, you have to look at the current state of colorectal cancer screening. It's a massive public health initiative, but patient compliance is notoriously dismal because the gold standard for detection is a colonoscopy, which is invasive, requires miserable preparation, and necessitates taking a day off work.
So the medical community tried to solve that with at-home tests.
Yeah.
The traditional alternative has been the FIT test, the fecal immunochemical test. But the FIT test relies on a very crude biological mechanism. It literally just looks for microscopic traces of blood in the stool.
Yeah.
The problem is, by the time a polyp or a tumor is large enough to consistently bleed, the cancer is often already in a more advanced, dangerous stage. Furthermore, things like hemorrhoids or even certain foods can trigger false positives. It is a blunt instrument.
Which is why the underlying science of ColoSense is so disruptive. It doesn't just look for blood. It analyzes RNA biomarkers. As cells in the colon naturally slough off and are passed in the stool, ColoSense can detect the specific altered RNA signatures that indicate the presence of precancerous advanced adenomas or early-stage colorectal cancer.
So it's looking at the genetics.
Exactly. It identifies the biological blueprint of the disease long before it ever starts bleeding.
And doing RNA sequencing in a highly controlled hospital laboratory is one thing, but designing a chemical buffer system that can stabilize fragile RNA biomarkers in a stool sample, in a plastic tube, sitting in a hot mailbox in Arizona for 3 days while it ships back to the lab, that is an incredible technological feat.
It really is.
They have essentially miniaturized and decentralized advanced molecular diagnostics. The patient collects the sample in the privacy of their own home, drops it in the mail, and Labcorp handles the rest.
It fundamentally removes the friction from preventative care. While it is currently in the early launch phase, they rolled it out nationally in June, the market adoption signals are incredibly strong. It has already been included in the American Cancer Society guidelines, and crucially, it has secured Medicare coverage.
And when Medicare agrees to pay for a test, private insurance companies almost universally follow suit. But developing a revolutionary test is useless if doctors don't actually prescribe it. Which brings us to the second major tech initiative they announced: an expanded integration with Epic.
Epic is huge.
For anyone outside the healthcare industry, you cannot overstate the dominance of Epic. It is the colossal electronic health record system used by a massive percentage of hospitals and physicians in the United States. It is basically the operating system of American healthcare.
Historically, if a doctor wanted to order a specialized Labcorp test, they had to log out of their Epic system, log into a separate Labcorp portal, manually enter all the patient data, order the test, and then constantly check back to see if the PDF results had been uploaded.
Right.
It was a clunky, time-consuming workflow.
Doctors hate administrative friction. If a test takes 5 extra clicks and a new password to order, they simply won't order it.
Recognizing this, Labcorp announced a deep integration with Epic's Aura platform. They are embedding their entire catalog of over 6,500 diagnostic tests directly into the native Epic interface.
To use a tech analogy, it is like getting your software pre-installed on the home screen of every iPhone in the world. The doctor doesn't have to leave their primary dashboard. They click a button within Epic, the order is sent directly to Labcorp, and the discrete data from the results flows automatically back into the patient's Epic chart, where it can be charted over time or trigger automated clinical alerts.
By embedding their menu directly into the physician's daily workflow, Labcorp is building an insurmountable distribution moat against smaller regional labs.
When you combine that seamless B2B integration with their direct-to-consumer push, like the Labcorp OnDemand platform, where a patient can bypass a doctor entirely and just pay out of pocket to order their own comprehensive vitamin panels, hormone tests, or genetic screens, you see the architecture of a true health data platform. They are aggressively attacking the market from the clinical side, the pharmaceutical side, and the consumer side simultaneously.
It's a three-pronged attack.
Which perfectly transitions us into Section 3, management guidance and the risks. We know what they have done in the past, and we see the structural advantages they are building for the future. But the stock market doesn't care about what you did yesterday. It only cares about what you are going to do tomorrow. Did management provide any clues on how these new initiatives are impacting their financial forecasts?
In the world of corporate earnings calls, there is a specific sequence of events that acts as absolute catnip for institutional investors. It is the phrase, beat and raise.
Music to an investor's ears.
Exactly. Labcorp beat the Wall Street consensus estimates for the second quarter and then immediately raised their financial guidance for the remainder of the year.
Let's look at the exact revisions. Management increased their full-year enterprise revenue guidance to a range of 5.4% to 6.3%. But more importantly, they bumped up their full-year adjusted EPS guidance. The new range is $18.10 to $18.55 per share.
Right.
If they hit the midpoint of that new guidance, that represents an implied earnings growth rate of more than 11% for the year.
And if you dig into the segment-level guidance, it reveals exactly where their confidence is coming from. They raised the revenue guidance for the Diagnostics segment by 20 basis points, but they bumped up the guidance for the BLS segment by a very aggressive 140 basis points.
Wow, 140.
Yeah, that massive upward revision is heavily driven by the compounding strength of the Central Labs unit, combined with the fact that they upgraded their expectations for the newly restructured early development unit from flat growth to low single-digit growth. They are seeing the early-stage pharmaceutical study starts happening on schedule, and they have clear visibility into the back half of the year.
But the most profound signal of management's confidence isn't found in a spreadsheet projection. It is found in how they are allocating their actual cash. Along with this earnings print, the board of directors announced the approval of a massive $1 billion increase to their share repurchase authorization.
Yes, that brings the total outstanding authorization to $1.4 billion.
This is a critical moment for you, the retail investor, to understand capital allocation strategy. A company generating massive amounts of free cash flow essentially has three options. They can reinvest it into the business by building more labs, they can pay it out to shareholders as a cash dividend, or they could use it to buy their own stock on the open market and retire those shares.
Which is exactly what they're doing.
Right, and I often hear retail investors complain about buybacks. They say, why spend $1 billion on your own stock? Does management lack the imagination to invent a new product? Why is this actually a massively bullish signal?
It comes down to the math of internal return on invested capital. Imagine Labcorp could build a massive new testing facility, but based on their projections, that new facility would only generate an 8% annual return on the capital they invested to build it.
Okay.
At the same time, management looks at their own stock price, looks at their locked-in $8.7 billion backlog, and calculates that the market is severely undervaluing them. They realize that buying their own stock at the current depressed price effectively yields a 12% return. Mathematically, it is fiduciary malpractice to build the 8% lab when you can buy the 12% stock.
And it fundamentally alters the EPS calculation for every remaining shareholder.
Yeah.
Earnings per share is a fraction total profit divided by total outstanding shares. When Labcorp goes into the open market and permanently retires $1 billion worth of shares, they shrink the denominator of that fraction. Even if their overall profit stays exactly the same, the earnings per share mathematically increases for every investor who continues to hold the stock. It is the most direct, tax-efficient way a management team can artificially, yet permanently, boost the value of your portfolio. When a board authorizes $1 billion buyback, they are screaming to Wall Street, "We believe our stock is on sale and we are backing up the truck."
It is the ultimate display of financial conviction.
Okay, we have painted a very rosy picture. expanding margins, brilliant tech integrations, expanding backlogs, and $1 billion buyback. But I promised our listeners at the beginning that we would be objective. There is no such thing as a risk-free investment, especially in a sector as heavily regulated as healthcare. Healthcare economics are intimately tethered to government policy. What are the macroeconomic and legislative threats that could derail this massive momentum?
Management flagged 2 specific legislative issues during the call that require careful monitoring. They're both highly complex, but they are essential to understanding the regulatory environment Labcorp operates within.
Let's lay them out impartially, relying strictly on the facts presented in the transcript. What is the first major headwind?
The first issue revolves around the Affordable Care Act, or ACA, specifically regarding recent changes to Medicaid eligibility. To provide the necessary context, during the height of the COVID-19 pandemic, the federal government enacted continuous enrollment provisions.
Right.
Essentially, they told states that they could not kick anyone off the Medicaid rolls, regardless of whether their income had increased above the eligibility threshold. This led to a massive, temporary swelling of Medicaid enrollment nationwide.
But that provision was a pandemic emergency measure, and it has recently expired.
Exactly. The emergency ended, and states have resumed the process of redetermining eligibility. They are auditing their Medicaid rolls and removing individuals who no longer financially qualify. Predictably, this has led to a significant number of people losing their government-sponsored health coverage over the past few quarters.
How does that affect Labcorp?
Management noted that this dynamic, fewer people having active insurance coverage, created a slight 20 to 30 basis point headwind to their diagnostics volume in the second quarter. If people don't have insurance, they are less likely to go to the doctor for routine preventative blood work.
So the unwinding of pandemic-era Medicaid expansion is causing a slight drag on their testing volume. Did management express panic over this?
Not at all. CFO Julia Wang was very quick to contextualize the threat. She pointed out that this specific cohort of Medicaid patients accounts for a very small percentage of Labcorp's overall diagnostic volume, somewhere in the neighborhood of less than 4 to 5%.
Well, that's tiny.
Yeah. Furthermore, analysts were worried that people losing coverage might still get tests, but then fail to pay their bills out of pocket, causing a spike in bad debt. Wang confirmed that bad debt remains remarkably consistent with historical benchmarks, sitting at less than 5% of total revenue.
Okay, so while the Medicaid unwinding is a factual headwind, it is highly isolated, incredibly manageable, and management confirmed it is already fully baked into their updated raised guidance model. What is the second legislative threat?
The second threat is an ongoing piece of legislation known as PAMA, the Protecting Access to Medicare Act. This requires a bit of historical context. Historically, Medicare paid for laboratory tests based on a static, arbitrary fee schedule set by the government.
Okay.
A few years ago, Congress passed PAMA with the intention of moving Medicare to a market-based pricing system. The law mandated that labs must report the rates they negotiate with private commercial insurance companies, and Medicare would then adjust its reimbursement rates to match the median of those private market prices.
That sounds entirely reasonable in theory. The government wants to pay the same price that private corporations pay. Why is this a risk?
Because the initial implementation of the data collection was severely flawed. The government primarily collected pricing data from the massive independent laboratories like Labcorp and Quest Diagnostics, which negotiate heavily discounted rates with private insurers due to their massive scale.
Wait, do they ignore the smaller labs?
Exactly. The government failed to collect sufficient data from smaller local hospital laboratories, which typically charge vastly higher prices. Because the data pool was skewed heavily toward the lowest cost providers, PAMA resulted in drastic, devastating cuts to Medicare reimbursement rates across the entire laboratory industry.
So the government used Labcorp's own hyper-efficient pricing against them to slash Medicare payouts. And CEO Adam Schechter noted that another round of these PAMA pricing cuts is slated to occur next year.
Correct. However, Schechter also highlighted that there is an ongoing bipartisan effort in Congress to fix this flawed system via a bill called the Results Act. The Results Act aims to delay the impending cuts and reform the data collection process to ensure it accurately reflects the entire market, including those higher-priced hospital labs.
So they are fighting back.
Yeah, Schechter stated that the data submission deadline for laboratories was literally the day after this earnings call, and that Labcorp is actively lobbying for the Results Act.
So they are fighting a legislative battle over reimbursement rates. But here is how I contextualize this risk, based on everything else we have discussed today. Think of these regulatory changes like a toll booth being constructed on a newly built highway. You have this massive, incredibly efficient logistical machine, Labcorp, barreling down the highway. They have 5.8% revenue growth, huge margin expansion, dominant specialty testing, and a $1 billion buyback engine pushing them forward.
They have tons of momentum.
Exactly. These legislative issues, Medicaid redeterminations, and potential PAMA pricing pressures, they act like a toll booth. They might cause a little temporary drag. They might force the company to pay a small tax on their momentum. But they aren't destroying the highway, and they aren't stopping the forward momentum of the company. In fact, if PAMA cuts do go through, it actually hurts the smaller, inefficient hospital labs vastly more than it hurts a giant like Labcorp.
That's a great point.
Labcorp can survive the margin compression through scale. The small hospital lab might go bankrupt, allowing Labcorp to either acquire them for pennies on the dollar or take over their outsourced testing volume entirely. It's almost a perverse competitive advantage.
That is a highly pragmatic assessment. The structural advantages Labcorp has built in high-margin specialty testing and global pharmaceutical services provide a massive shock absorber against generalized regulatory pricing pressure. The risks are known, they are quantified, and management still felt confident enough to raise their full-year earnings guidance.
Which brings us perfectly to the final section of our deep dive. We have analyzed the headline numbers, we have translated the underlying mechanics of their growth, we have reviewed the guidance, and we have soberly assessed the risks. It's time to make the call. What is the bottom line? Is this earnings print a bullish or bearish signal for the retail investor?
Based on the preponderance of the data, the structural improvements in their operating margins, and the undeniable strength of their forward-looking backlog, the bottom line is unequivocally bullish.
I completely agree. Let's synthesize exactly why this is a definitive Talk Tickers buy signal, summarizing the core thesis without just repeating the data.
First and foremost, Labcorp is actively and aggressively stealing market share. Their diagnostics segment is generating organic growth of 3.6%. As CEO Adam Schechter explicitly noted on the call, the broader laboratory testing market typically only grows at a decline rate of 1 to 2% annually.
So if the market is growing at 1.5% and Labcorp is growing at 3.6%, that extra volume isn't materializing out of thin air.
They are taking it directly from their competitors by leveraging their superior specialty testing menu, like the pharmacogenomic and oncology panels we discussed, and their seamless software integrations like Epic Aura.
Second, the execution risk regarding their historical problem areas has been completely eliminated. The strategic restructuring in the early development unit is finished. The heavy lifting, the severance packages, the facility closures, it is all in the rearview mirror.
And the result isn't just a promise of future efficiency. It is mathematically visible right now in the massive 130 basis point margin expansion in the BLS segment. The turnaround is complete, and that segment is now a compounding growth engine rather than an earnings anchor.
Third, they possess incredibly high revenue visibility. A book-to-bill ratio of 1.14 on a massive $8.7 billion clinical trial backlog guarantees a healthy, expanding pipeline of future cash flow from the pharmaceutical industry. The massive global drug companies trust Labcorp to handle their most sensitive data, and that relationship is sticky.
It's very sticky.
And finally, I will connect it directly back to you, the retail investor listening right now. When you are deciding where to deploy your hard-earned capital, you are ultimately betting on a management team's ability to execute and their willingness to respect the shareholder. When a massive healthcare titan successfully expands its operating margins across both of its primary business segments, flawlessly digests a massive acquisition like Invitee without missing a beat, raises its full-year guidance for both top-line revenue and bottom-line earnings, and then authorizes a brand new $1 billion share buyback program. That management team is aggressively rewarding the people who hold their stock.
They're doing exactly what a mature, highly profitable enterprise should do, optimizing their core business, aggressively pivoting toward high-margin precision medicine, and returning the excess cash flow directly to the investor.
The mechanics of the business model are defensively incredibly sound, yet they are still finding avenues for aggressive growth. It's a rare combination in the current macroeconomic environment.
Very rare.
All right, before we sign off, I want to leave you with one final provocative thought. Something to mull over and research on your own as you watch this stock trade over the next few quarters. Throughout this deep dive, we spent a lot of time analyzing their B2B operations, their clinical testing for doctors, and their trial services for pharma giants. But if you look closely at the edges of this transcript, you see the foundation of something much larger. We discussed the launch of the FDA-approved at-home ColoSense test, which decentralizes cancer screening, During the call, the CEO also casually mentioned that their MyLabcorp mobile app, an AI-powered platform where patients can schedule appointments, pay bills, and view their clinical test results using artificial intelligence, has already been downloaded by millions of consumers.
Which forces us to ask the multi-billion-dollar question. Are traditional laboratory companies like Labcorp quietly transforming into the primary digital health hubs of the future?
It's exactly. Right now, Wall Street values Labcorp primarily as a back-end service provider. But what happens if they successfully transition into a direct-to-consumer data ecosystem? Imagine a near future where Labcorp becomes the central hub where patients independently manage their own biomarkers. You bypass the general practitioner, you open the MyLabcorp app, you order your own genetic panels, you take an at-home blood test, and their integrated AI tracks your long-term metabolic health trends entirely outside the traditional fragmented hospital system.
If Labcorp owns that direct-to-consumer relationship and owns that longitudinal health data, how does that fundamentally change the multiple Wall Street assigns to this stock over the next decade? Are they just a logistics company moving vials of blood, or are they the ultimate consumer health technology platform?
And with their deep integration into massive electronic health records like Epic, they are positioning themselves to be the indispensable bridge between consumer-driven health tracking and traditional clinical care. It is a strategic positioning that very few companies on Earth could replicate.
It is the ultimate hidden in plain sight narrative, and it is exactly why we do these deep dives.
Thank you for joining us on this special Talk Tickers edition. Remember, the polished numbers in a press release are just the beginning of the story. You have to read the transcript, understand the mechanics, and follow the cash. Stay curious, ignore the noise, and keep looking at the data.